our station. Professor Don Bush here. I've been teaching for about 30 years and been a CPA for about that long, and I've got great ways to explain accounting. So welcome aboard. Let's get rolling. Today's lesson is about cash flow statements, and we're talking about the indirect method. There are two ways to do a cash flow statement: the direct method and indirect method. The people that make up the accounting rules and regulations are pushing the direct method, but the indirect method tends to be more popular. And I like the indirect method. I think it shows us a lot about how a business is run, and we can get a lot of information from the cash flow statement using the indirect method. I'm a big fan of it. So this is the first example of the operations section. As you probably know, there are 3 sections to the cash flow statement, and we are going to focus on the first section only, operations. So here's what we need. We've got an income statement and we have a balance sheet. Now the income statement is dated year ending December 31st, 2002. And the balance sheet has 2 columns here, 2001, 2002, and then the change. And the balance sheet, what we need is we need the last year's balance sheet, which would be 2001. So these are last year's ending numbers. And here we have a balance sheet for 2002. So here are the numbers for this year, the ending numbers for this year. So we're going to find the difference between the two. So let's see what's going on here. Well, the income statement is done on an accrual basis. That is, revenue is recognized when we do our job, do our work, and we try to match revenues and expenses together. But we're trying to do a cash flow statement, and a cash flow statement is done on a cash basis, obviously. And so we need to take this income statement and transform it into a cash basis. So here's what we're going to do. I've got highlighted in bold here in a little darker blue color. I've got net income here, 32,000, and so we're going to start with that number, and then what we're going to do is add back depreciation expense, because depreciation expense has nothing to do with cash. There's no cash involved with depreciation. Now those are the only 2 numbers that we need off the income statement: the bottom line net income and depreciation expense. All of the other expenses are fine the way they are, and we're not going to use them. Even though this is a cash flow statement, we're not going to use cash in calculating the cash flow. This is actually going to be our answer. At the bottom of our cash flow statement, we would have that cash started out at 5,000 and it ended up being 7,000, so it must have grown by 2,000, and that's our answer to the cash flow statement. But what we're going to do is we're going to look at other current assets and other current liabilities, and we're going to determine if the current assets and current liabilities increased and decreased and how that affected cash. So here we go. This is what's going to go on here, is that accounts receivable. Accounts receivable grew from 3,000 to 4,000. Now what this means is the business is making sales, but they're not collecting their money. And this is a cash flow statement, so we have to think, okay, you're not collecting your money. That's money not coming in. The change here is $1,000, and you'll see how this works out. We have inventory. Inventory went from 6,000 to 5,000, so hopefully we're selling that inventory. So inventory decreased by 1,000. Coming down here, we have accounts payable. Accounts payable was 4,000, now it's 5,000. It appears that we are borrowing money from our suppliers, $1,000. And then taxes payable was 2,000, it dropped down to 1,500, so it looks like we're paying our taxes. We paid $500. So let's see how this all gets put together. So what I'm going to do is I'm going to split the screen as best I can. There we go. So we now have a split screen so we can see what's going on. So we're only doing cash provided by operating activities. We're not going to focus on anything else. So here's our cash flow statement. So we're going to take net income right off the income statement. Here it is. Net income $32,000. Now, if it was a net loss, we would just write down a net loss. It's just that easy. And then, as mentioned, we are going to add back depreciation expense. And we find that on the income statement also. So add back depreciation expense of $5,000. Now, here's the part where you got to think a little bit. We're looking at our current assets and current liabilities. Now, the first current asset here that we're going to look at is accounts receivable. And accounts receivable grew from $3,000 to $4,000. So accounts receivable grew by $1,000. And once again, when accounts receivable grows, that means you're making sales, but you're not getting paid. And this is a cash flow statement, and not getting paid is not good. So here's what we're going to do. Even though accounts receivable grew by $1,000, we're going to say less increase in accounts receivable. So we're going to minus $1,000. So here's what's happening is when current assets increase, like it did here with accounts receivable, it's going to show up as a negative number on the cash flow statement. And it's easy to remember if you just recall, when accounts receivable grows, that means you are not getting paid. It's not helping your cash flow. And then coming down here to inventory. Inventory was $6,000. Now it dropped down to $5,000. That's because we're selling our inventory. So our inventory decreased. So we're writing this here on our cash flow statement as add decrease in inventory $1,000. So why are we adding a decrease in inventory? Well, here's what it is if you're selling your inventory, you're bringing in money. That's a really easy way to think of it. Actually, the answer is a little bit more complicated than that, but I like the simple way of thinking about it because it's fast, easy, and it always works. So when inventory drops down in value, that's because you're selling your inventory, and when you sell things, money comes in. So there you go. So it's a positive $1,000. Now it's important that we label this cash flow statement as we are. We're saying less increase in accounts receivable, add decrease in inventory, because we need to be descriptive on what's going on. Coming down here to current liabilities. Now current liabilities, accounts payable, it starts out at $4,000 and it ends up being $5,000. That's an increase of $1,000. So we have add increase in accounts payable $1,000. And the reason why we're adding is because when accounts payable goes up, we're actually borrowing money in a sense here from our suppliers. So it's a positive number. And then we have taxes payable. Starts out $2,000, drops down to $1,500. That's a decrease of $500. So it looks like we're paying our taxes, so we have less decrease in taxes payable, $500. And then what we do is we add this column up and we have net cash provided by operations. And you can see here that the net cash provided by operations, $37,500, is a little bit different, not a whole lot, from net income. Now you would expect that net income and operations, cash flow from operations, to have a little bit of a correlation. At least I expect that. And in this case, we certainly do. So nothing strange and weird is going on. So just to review just a little bit here, when current assets go up, that's going to be a drop in cash flow. So remember it this way. When accounts receivable goes up, that means we're selling our stuff, but we're not getting paid. So it's a negative cash flow. And when current assets go down, like it did for inventory, this is a positive cash flow. So that's a little tricky to remember. Current liabilities don't work quite that way. When current liabilities go up, that means you're borrowing, and when they go down, it means you're paying back the money that you owe. So there you go. So there's your first introduction. What I did here is I just, for the sake of completeness, is I included the other two categories, even though we're not working with them today. We've got cash provided used by investing activities, and just as a review, that's sale of long-term assets or purchase of long-term assets. And then financing activities, that's either borrowing money on a long-term basis or paying back long-term debt, or owner investments like selling common stock, or owner withdrawals like dividends. So there you go. So there's the cash flow statement. So folks, this is your very first introduction to how to do the cash flow statement. It's a little tricky at first, but with a little practice, you get the hang of it, and it's really not that hard. So if this video helped you out, let me know, and hit that like button and subscribe button, and I'll see you next time.